Hello investors and future investors, welcome to the channel. In today's video, I will show you how to roll your options to save money and ultimately save the trade. If you're new to the channel, thanks for stopping by. On this channel, we help you with option strategies that can give you consistent revenue and everything related to finance and investments. And yes, you too can make money from your living room with options trading, and I will show you how. And all I ask in return for this content is an early thumbs up by you hitting the like button. And while you're there, consider subscribing for more ways to win with options. Welcome to Investment Gains. Let's jump right into it. So, the age-old question is going to be, why do you want to roll your options? There are several reasons why you'd want to roll your options. That includes to save money, to save the trade, or do both. Now, there's a common fallacy that most traders think that the only time you need to roll over an option is when you're losing. That is not so. Options can be rolled over even if you're up on the trade and you want to maximize your gains. And I will show you how. Do not worry. So for today's video, I'm going to be using two stocks. One that pays low premium and one that pays very high premium. So you can see the difference. So let's start off this video by using Apple, ticker AAPL. So here we are on my Apple's sell call. Now the reason why I choose to use Apple is to show you that you don't need to wait until you're in a losing trade in order to roll your options. So here you can see my Apple trade expired on the 27th of August and the return is $31. I'm up 83%. Now, although I'm up 83%, my strike price is going to be 152.5. Now, Apple currently is trading at 148. Now, the difference between 148 and 152 is huge for a stock like Apple that does not move that much. So what I'm going to show you right now is that if I wanted to, I could roll down this option. So when rolling your options, there's several ways you can do it. You could roll up your options, you could roll down your options, or you could roll out your options, and then you could mix and match. Meaning you could roll down and out, you could roll out and up, etc. But the only way for you to get your foot in the door with rolling option, you must practice. So we're going to go into view all Apple options. Now the first thing you want to do when you rolling options, you need to first find your original contract. So my original contract is a sell call for 152. Now in order for me to start the first process of rolling this option, I must first buy it back. So make sure it says buy and call, make sure it has the correct strike date, and then we're going to select it. Now, this video is just to show you how to roll options, because if I wanted to, I could close out this option right now and take my gains. However, I'm just going to use it to show you how to roll options. Good. So like I was saying, the first part is to buy back your option. Once you have bought back your options, then you're going to go now and you're going to sell your option. So let's go to sell. Now for this case, I'm going to leave the same expiration date of August 27th. Or what I'm going to do, I'm going to roll down this option. So by rolling down, I'm going to go now and choose a lower strike price, which is going to be 150. Now what this rolling down is going to do is going to give me an additional credit. So it's going to give me the difference between 0.28 and 0.06, which is going to end up being an additional $22. Now this is called rolling down your options. Now, why would you want to roll down your option? Well, as you all know, last week the market completely tanked. Now, if the market completely tanked and you're having a sell call that's really high up, you can increase your gains by rolling down. So there you see, you do not have to wait until you're in a losing trade to roll your option. You can do it even while you're winning the trade. So by rolling this trade down, I'm going to receive an additional $22 in addition to what I already received. Now, this is a lot riskier. The reason it's riskier is because now you're taking your strike price and you're bringing it down. Now, secondly, what we're going to do, we're going to roll up. So why do you want to roll up your option? Well, you want to roll up your option if your strike price has already been surpassed. So let's say that right now Apple is trading at $153, which is going to be higher than my current strike price. Then I will be losing the trade. So what I can do is I can roll up the option. Now, in order to roll up the option, it's the same process. You need to first buy back your option, then you're going to go sell another option against it. So once again, we're going to buy back this option, and now we're going to sell the option of 155 right above it. And for that, we're going to receive 3 cents or $3. As you well know, each option contract is multiplied by 100. So why would you want to do this? Well, you want to do this depending on your position in the stock. So for instance, I do not own 100 shares of Apple. I have one leaps contract of Apple in which I use to generate weekly revenue. So it is in my benefit to not lose the leaps. So it's better for me to pay $3 to save the trade than to lose the leaps, and I won't be able to continue making regular revenue. So now we're going to go into the third one, which is rolling out. So we did rolling down, we did rolling up, now we're going to do rolling out. Now rolling out has to do with the date pretty much. So once again, we're going to buy back our option first of all right here. Then we're going to sell another call against the one that we just bought back. Now rolling out means we're going to select a strike date that's further out. So let's use September 3rd for this example. So why do you want to roll out? Well, you want to roll out if you're down on a trade and you want more time in order for the stock to recover and go in your favor. So we did buy back our call at 152. Now we're going to sell another call at an extended strike date. So now that you have rolled out your date, now you could choose your strike price. Now choosing your strike price is going to depend on whether you're bearish or whether you're bullish on Apple. Now, if you believe Apple is going to go up just a tad, then you could always choose the strike price a bit higher. If you think Apple is going to continue to go down, then it's your benefit to choose the strike price much lower. Now, I'm going to use the much higher one because I do not want to bet against the market. So by choosing the higher one and going out 1 week, we're going to receive an additional credit. So rolling up and out can give you an additional credit. Rolling up and down can also give you additional credit, or it can also be a cost. Like I said at the beginning of this video, the only way for you to get this, you need to constantly keep practicing. Do different scenarios and then you choose which one is more beneficial to you. Now that we did this with Apple, now we're going to do one with a more high premium stock, and you're going to see that there's a major difference. So I'm going to use Mara. I do have Mara in my portfolio. That's why I decided to use this one. Okay, so here we are on Mara options. Now the first thing you want to do, you want to find your contract. So here's my contract, the $41 strike price, and then you want to buy it back. So I'm going to buy it back and it's going to cost me $132. Now we're going to go and we're going to sell a call against it, and we're going to go down a bit. This time we're going to choose the $40 strike price. I'm going to roll it down. Now for rolling it down, I'm going to receive $1.63, and the difference between the two is going to be $31 or 0.31. So in this case, I'm going to benefit by getting additional credit. Now, I could also roll up, and I'm going to choose the $42 strike price, and now I'm going to have to pay for it. It's going to cost me $25. Now, lastly, I could also roll out, and we're going to choose a strike date 1 week extended, and we're going to choose a strike price of $42, and for that, we're going to receive an additional $43. So just to review, you do not need to wait until you lose in a trade in order for you to roll your options. Options can be rolled at any time. So we have lots more strategies like this on this channel. So if you want to join the weekly income team, like and subscribe right now. Also, hit the notification bell to get an alert whenever I post a video. But most importantly, if there's anyone out there that can benefit from this content, feel free to share it with them. Let's help as many as we can. Thanks for watching, and remember, always take your investment gains.